What's going on, my stock market bulls and bears? I am your host, Terry, and welcome to the channel. Buy the dip. Guys, I wanted to come in here and do another how-to video, and this one's basically going to be options for beginners. We're just going to do this as educational purposes. Just want to get in here. I have a lot of people that's newer to investing, and I just want to keep it basics on basic options. I'm not recommending these options plays, guys. I'm not recommending them at all. I'm just doing this to teach you guys about options and the basics behind options. So the first one we're going to go over is buying a call. So if you are buying a call on a certain stock, and in today's video, I'm going to be using Ford, ticker symbol F, just as educational purposes. Don't be buying these right now. But if you believe that Ford, if you're bullish on Ford, and you believe the stock price is going to rise within a certain date, as you can see here, you can select any date you want. Now, you can do January 8th, which will be next week. You can go up to next month of February 5th, and the dates keep changing. So, but let's just say for this video, you want to go to January 15th. You think in 2 weeks that Ford stock is going to rise. Currently right now, Ford is at $8.77. So you believe that there's going to be big news coming out about Ford, and you're saying this stock's going to rise. How do I get the most gains for my it's going up? So you're going to buy a call. So you would want to buy a $9 call, and that would cost you $16. So you would go in here, you click that, you would click continue, and it would basically here you would show under contracts, you select one, boom, you review your order, and you would get your one contract. Now, what does this mean exactly? If you go in here and do this $9 call and you got 2 weeks to see what's going on, guys, and you see this stock price goes up, Robinhood will let you know how much money you made on this call. And the higher this price goes above $9 and the quicker it happens, guys, guess what that means? You're going to be making more money. So, as you know, every day passes by, you lose a little bit of your original investment. So, the good thing is the most you can ever lose on this investment is your initial investment of $16. So that is the plus of buying a call. Now, let's say the stock goes down. Well, then your $16 will start to dwindle down. And at expiration date on January the 15th, this stock isn't above $9. You're basically down at zero, guys. So, but the plus here is, let's say Ford has huge news about EV. They have the new Mach-E out now. And let's say Ford shoots up to $20. Well, guess what? Your $9 contract is going to be worth a boatload of money right now. So your $16 investment could be 10x, could be 5x, it could be 20x. You don't know. It all depends on how far the contract moves. All right, guys, so that first part was talking about my bulls out there. And that was if you think the stock's going up, you want to buy a call. So in this one, we're going to talk about the bears out there. And if you're in a company and you're looking at this company and you think that it's very overvalued, the stock price is way too high, and you did your research and you think this stock price is going to go down, you want to buy a put, which basically means you're predicting the stock price will drop. And on this one, I'm going to show you basically the chart here of Ford again, just for educational and learning purposes here, guys. So let's say here in February, this stock was at $9.18, which it was. But for some reason, you felt that Ford just isn't innovative enough. Their cars isn't being new and fresh. You were a big Tesla bull and you thought that Tesla is the future. So you thought Ford wasn't going to do anything EV related, and you felt Ford was going to drop down in price. So what would you want to do? You want to buy that put. So if anyone here on February 4th bought a put and they took this out here into, like, say April, could you imagine the contracts they would have got when this market crashed? Anyone that would have bought puts here in the beginning of March and at the end of March, woo, they would have been making some money. So let's go take a look at trading Ford options. Now, guys, we did buy a call in the first example. Now we're looking to buy a put. So you can see the share price is $8.77. And we'll use 2 weeks out as an example. January 15th gives you a little bit of time to see what happens. So, as you're going to see here, guys, if you get down here your first option below the share price, now you can go above. You'll start paying higher premiums because those are considered in the money contracts, which almost means If the stock goes down, you'll get more money on your premium. So just for educational purposes, we're going to use the 850 share price. We're going to click that. And we continue and we do one contract. And it would cost us $13 to do that contract. Now, what does this mean, guys? Think about what we did in the calls. It's going to be the same for the puts. So every day this contract goes by, you're going to lose a little bit of that premium of your contract. Now, here's the plus. If this stock tanks and it drops down low, your $13 investment could be 5x, 10x, 20x. It all depends on how far it drops and how quick it drops. So if you buy this like on Monday and this thing tanks down on Tuesday, your contract's going to the moon real quick, guys. It is going to rise up real quick. So we did some options here on my channel. We've had some good, we had some bad. And as you know, news can play a lot into what's going on, man. So you got to be very careful with these options. I just highly suggest that before you do options play, you would almost treat it as if you're okay with losing the money. That's the best advice I could give you. If you're willing to do an options play, you got to look yourself in the mirror and say, am I okay with losing this money? Because it's a high possibility you will lose that money. It's a very high possibility when you do a straight up options, either buying a car, buying a put, you will lose money. It is almost a guarantee. And don't get greedy on options, guys. I can't stress that enough. Do not get greedy on your options. If you're looking at your options profit and you're up over 100, 200, 300%, and depending how many contracts you got, I highly suggest that you start cashing those out. Maybe not getting rid of all. Say if you had 5 contracts and you're up over 100%, maybe cash 1 or 2 of them out. Start taking home some of that profit. Don't get too greedy unless you're okay with risking it. But like I say, man, you got to be very careful on these options. So guys, hope you all enjoyed today's video. Hope this really helped out on buying calls and buying puts and maybe making this a little bit easier, explaining on what you can do. But like I said, the good thing is about this investment, the most you can risk on this one is $13 for 2 weeks to see what happens with Ford. Now, if this price goes up, you lost your $13. But if the price tanks, you made a lot of money. You know, you could 5x, 10x your money on here. So that is the basis of this, guys. Whatever you pay for your contract is the most you can lose, and you got to be okay with losing that money as a possibility. So guys, hope this video really helped you out. If it did, please hit that thumbs up. Join the Thumbs Up Nation. I love and appreciate every single one of you. And guys, I will catch you in the next one. Remember too, buy the dip. Right there it is. So baby, let's go.